rates. We'll look at, of course, the indices, we'll look at the Nifty heat map, and then we will proceed to look at individual stocks. I mean, it's nowhere near what GIFT Nifty in the morning was showing. And yeah, I mean, it was showing a 100-point downtick, and it did seem strange. I mean, why should market overnight was slightly lower, but a 100-point cut didn't square. The Nifty is absolutely flat. The Bank Nifty is absolutely flat. That's more like it. And you've got the mid-cap index, which also will come up on your screen. Remember, yesterday, the broader market did much better. And that was a silver lining. Micro, mid, small, everything did very well. Mid-cap index is down about 0.25% right now. And the Nifty is down about 20, 30 points. Mid-cap index is down 70. So that's under 0.25%. Overwhelmingly, the Nifty heat map shows you that 35 odd names are in the green, in the red, and about 15 odd names are up in the green right now. So yeah, it's a lower start, and maybe it will expand and the cut will become larger. We'll see. But to begin with, it's about 20, 30 points. Surabhi.
Okay, and it's all about Cipla and L&T, the stocks that we were just discussing. Cipla is up 7.5%. Remember, this VAI, voluntary action indicated, is not as severe as an OAI. So basically, it's good news for their Goa facility, which is really helping the sentiment around the stock. L&T up 4.5%. Smart showing over there on the second quarter performance. There's Dr. Reddy's, which is up and about. And some of the auto stocks, by the way, are still continuing. A little bit of green from yesterday. Hero Moto, Bajaj Auto. These are stocks that are managing about 0.5% to about 1% sort of an up move. There's ICICI Bank that's trying to fight for the bulls. Let's see, HDFC Bank and Kotak, even Axis. The banks are absolutely at the flat line. The next couple of minutes and hours will determine where they go and where they take the market with them. Right now, they're at the flat line, so let's watch. If we talk about the weak hands, then IT is selling off today. Tech Mahindra, Infosys, TCS, all these stocks on the downside. Apart from this, there's some profit taking on consumer names like Titan and Trent. Both are weak. Even Asian Paints is weak. ITC is weak. So yeah, those seem to be the early trends as of now. Consumer weak, IT weak, banks, undecided as yet, and Cipla and L&T are your large cap stocks of the morning.
Well, that's right, Surabhi. And from the broader markets, so plenty of stocks moving around. Axo Nobel, there are a couple of articles that suggest that the promoter entity will be looking at, getting out of this business here in India. That stock's up close to around 8%, so volume's not very, very high though on that one. Prudent Corp, that stock is up close to around 7.5%. Volume's picking up on that particular name. DCM Shriram, that's another one that's gaining big time in today's trade. So that, in fact, is up close to around 7.5%. So good move is what we're seeing out there. A couple of stocks have been in upper circuit. DCX Systems, they had that order win that came in there. The stock, though, had corrected sharply from the recent peak. Then a couple of other names, Coffee Day is up close to around 5% or thereabouts. On the losing end, you get a couple of stocks actually that are moving on very, very large volume. Genesis is now down close to around 8%. So big down move is what you're seeing. Five-star business, they trimmed down their growth guidance. They've trimmed down their yields as well. And after seeing a cut of 14% yesterday, well, it's down another 5% today. So big downtick is what we're seeing out there. Automotive Axles, that's the other stock in there. That's down close to around 5%. But otherwise, the headline index is more or less flattish. Breadth of the market pretty much even, Stevens. The Nifty Bank putting its hand up once you get counted today.
No, I mean, absolutely. And, we'll sort of get you more stocks as we go along. For now, we're down Nifty. I think I saw a larger cut, but it's been quickly pared back. We're down about 30 points. So 24,300 or so is where the Nifty is now trading at. Autos is another pack, right? I mean, we keep an eye. So we get sales numbers tomorrow, and you get a glimpse of what at least part of the festive sales have been like. So in that sense, whether it's as bad as what the sentiment is, or perhaps is a little better. So at the margin, there could be some moves here for individual names. Hero ended up 2%. It's up another 0.5% right now. And the other auto companies are all coming up on your screens as well. Maybe just a few other things. It's actually, out of the gates, it's 1:1. One up for one down. So advanced decline is flattish, absolutely flattish. Walkhard is up 3%, and it'll come up on your screen, 1186 or so on Walkhard. There is Prudent, which is a mutual fund distributor, 6% higher, 2890. It's got large volumes in it. There's New India Assurance, 2.5% in the green. Life insurers have all been seeing a flip-flop. Day before yesterday, they were all higher. Yesterday, they were all lower. So not very much change by the end of the two sessions. You've got Godavari, which is up about 2.33%. DCM Shriram is up 7%. I think it was mentioned earlier. Reddington is up about 5%. These are all got large volumes. The number one volume traded counter right now is, of course, L&T, which is looking very, very good. But it's 1:1 still in terms of what's up and what's down. 5-star is down 6.5 after yesterday's near 12% cut. It's down another 6.5 and it's ranking as the 5th largest volume-led loser across the board on the NSE. And look at Manappuram. Manappuram is down about 4.33%. And look at IRB as well. IRB is down 3.5. You'll hear from the management a little later here on the program. So lots happening as far as specific stocks are concerned. Not very much to show for it on the Nifty, which is down about 14-15 points at this stage. Nigel, you want to take it?
Just one more stock.
Yeah.
You know, Genesis, the volumes are very, very high. Last couple of days, the stock actually was up close to 12-13%.
Yeah.
It appears large equity has changed hands out there. So it'll be interesting to see who exactly was the, the party out there. Because if you look at it, the stock was down close to 10-12%. Now it's pulled back from the lows. Very large trade took place at much lower levels. We'll keep an eye on that.
You know, so from 666, it went up to about 830.
Yes.
And in 2 days, and now it's seeing a bit of a reversal, 4.5% lower. 2 million shares. Don't see that usually for a name like this. Right at the word go. Prateek Gupta is our market master today. He's CEO and co-head of at Kotak Institutional Equities. Prateek, thank you very much for joining us. Happy Diwali to you, your team at Kotak, your family. And it's, of course, great to have been chatting with you over the years. Thanks very much. So let's tackle the big question, Prateek, which I think you maybe won't have a definitive answer, but you can give us some color. Foreign selling, Prateek. You service pretty much all the large FIs here in India and in the region as well. What's the sense you're getting, really?
Good morning, Prashant. Happy Diwali to all of you at CNBC and also to all your viewers. Thank you for having me on the show today. As far as foreign selling is concerned, we think, unfortunately, the worst is not over as yet, especially as you head into a volatile period over the next 1 or 2 weeks. A couple of things. Firstly, fundamentally, you have the valuations in India, which are still somewhat expensive, even though we've come off about 9 or 10% from the top at the Nifty level. But as far as overall index is concerned, we're still trading at roughly 21 times 1 year forward earnings. Earnings growth is actually slowing down, and we don't have any signs of interest rate cuts either in the US or even in India. Even the RBI sort of pushing back rate cuts. So when you look at it from a valuation, earnings, interest rate or cost of equity perspective, all these factors are working against us. Now, on top of that, like I said, you've got a couple of events coming up. First is the US presidential election next week, which could, either way, we think it'll result in bond yields going up. They've already gone up quite a bit as the US economy seems to be pretty strong. Inflation's still running high. And that in turn is putting pressure on EM funds, EM outflows. And as and when the US election gets out of the way, we believe the Chinese stimulus is also likely to come through in response. One way or the other, they've been holding back for the US elections before they come out with their big stimulus package. We don't know how big or the exact timing of that, but in anticipation of that, the Chinese markets are also likely to be somewhat more robust. They've already run up a bit, but they've corrected, and everybody's waiting and watching to see what kind of stimulus China comes out with. So in an environment where with US bond yields going up, outflows or at best steady state situation with EM flows, you could see more foreign selling with money shifting from India to China or other parts of the world. That's one. Second is you have a ton of issuance coming through, IPOs, QIPs, which are coming through, which are likely to suck out liquidity. And even locally, investors are becoming a little bit cautious. And you're right, at Kotak, we do speak to pretty much anybody, any FII who invests in India. And by and large, unfortunately, despite the market correction so far, we still aren't getting any major inquiries or which stocks to buy or what's looking interesting, or are we getting close to price levels which are now worth considering. So by and large, investors still cautious and no rush. We are seeing decent participation in some of the IPOs and QIPs and blocks, but that's very tactical. Most of these things come at a discount to their prevailing stock prices or to their peers. So therefore, there's some interest over there. But it's not a very broad base. So unfortunately, in the very short term, things are looking a bit, we maintain our cautious view in the short term. But then again, if you take a slightly longer term view, we are more constructive. So, but let me just pause here and see if you've got anything else to ask.
Yes, we do, Pratik. Hi, plenty of questions. Season's greetings to you. Wish you a very happy Diwali to you and your team and all at home. So, yeah, I think, the festive season has come at an interesting time where I think investors are being forced to pause and sort of reflect, take a look around and reassess what they need to do. So then let's actually address that. Till we get more clarity on things like US elections, pace of US rate cuts, pace of India rate cuts, when these are beyond investor control, right? Till we get that clarity from a portfolio perspective, would you advise any more tweaks? There's been talk about, of course, taking money off the great capex trade, which I think you folks have already been fairly cautious on, just given the valuations in the run-up. But then consumer isn't quite kicking in. So what do you do? Portfolio call now.
So that's a great question, Surabhi. And I think basically what we are saying is in the coming year, if you look from Diwali to Diwali last year, we've had a great year. I think especially in the small mid caps, they're up about 45%. The Nifty is up some 23, 24% or so. So you've had a great year. Now it's time to get into capital preservation mode and moderating your return expectations for the next 6 to 12 months. And especially at a time when we're getting into a choppy global environment. Maybe things don't turn out to be as bad as we think or as the world is worried about. But nonetheless, one should be worried, especially just given where the valuations are right now. So from an overall perspective, we're advocating a slightly more defensive stance. And what does that mean? That means, one, for example, in the BFSI space, you stick more to the large private banks where asset quality is less of a concern, or perhaps even an SPI, which is another one on the PSUs that we like. We like life insurance, which is especially you have, the worst of the life insurance woes are behind us. They've had a pretty bad period last 3-4 years with COVID, with regulatory changes, surrender value, taxation, and so on. And there again, we think the worst is over. And also with interest rate cycle in the next 1 year turning down, that looks quite good. Telecom is another sector that we like, where again, with competitive intensity, with the third player sort of, still struggling. So, you can look at stocks like Bharti, for example. Or one could look at still, I think real estate still looks good to us. We're going through a little bit of a slowdown this quarter and maybe another 1 month or two, but that's structurally on a strong upcycle. There's plenty of demand out there. People are looking to upgrade. There's not enough, it takes time to put supply online. So, some of these are the sectors that we like. We would stay away from some of the defense type of names. We have been cautious over there. We still remain cautious, even though these stocks have corrected in some cases 30, 35, 40%. But still, from a valuation perspective, still expensive, would be a bit cautious. As far as the other capex plays are concerned, we think one can selectively start getting in. I can just share one name. We just today have upgraded Larsen and Toubro, just given how the stock price has declined. But even then, it's not a strong buy at this current valuation. It's something we like, but from a longer term scenario. But again, in the short term, next 3-6 months, this may just about move sideways. So basically shift to quality, shift to defensive, protect your returns, move to large caps away from small mid caps, where typically the valuation is a bit more frothy. So that's sort of the broad approach we are recommending right now. And consumption, we think it's still a bit too early. This slowdown could persist. You first need more of job creation, exports picking up, agricultural income coming through, government capex to pick up. Then you will start see a consumption pick up. So that's still, we think, probably 2-3 quarters away.
Hi, Pratik. Good morning. Good to see you in. I think from the consumption basket, you were leaning more towards staples versus discretionary, I think, a couple of months ago when we spoke. So is that still your preference? And also, the next indicator that we'll be getting with regard to how's the economy shaping up will be the auto sales. And the commentary has been mixed. The numbers as well on some counts have been disappointing. How are you approaching that space, the auto space? What do you prefer, two-wheelers?
Firstly, on the staples versus discretionary, yes, in a weaker consumer environment, people will spend on the essentials, and the potential for upgrading premiumization would be somewhat limited. So focus more on the staples, less on the discretionary. Discretionary usually picks up when, when income levels are good and people are willing to spend. That's not the case in the current scenario. So focus on staples. As far as autos are concerned, we have been cautious and we remain cautious. But at the same time, I would just say, I don't think things are as bad as perhaps the market commentary now is making out to be. We think a lot of the auto players have been far more disciplined this year in terms of stuffing inventory down the channel. Most of these companies report on their wholesale numbers, which can be quite misleading. So we think this time around, the situation is not as bad as it seems, but nonetheless, the overall weakness in the consumer space implies that auto sales will also remain weak, probably in single digits for both PVs, passenger vehicles, and for two-wheelers. In two-wheelers, we would still be cautious given the increase in competitive intensity. You've got the pure EV players who are who remain quite aggressive, and meanwhile, the incumbents are also coming back, and they're also ramping up in their distribution and product launches and so on. So autos, we would be careful. The only stock we like there is probably M&M, which will benefit from the tractor upcycle in our view.
Okay. Just briefly, Pratik, two things if you can address. One is, had China not risen, right, from the ashes, if I can put it a little dramatically, would all of this slight slowdown at the margin, etc., have mattered? Because now that's in a way, legitimate competitor for foreign flows, right? So you've got options in that sense. That is one. Is that what has changed for foreigners at the margin? Another option. And the second, you said this consumption slowdown could persist, and then you said some of job creation. Those are all structural, fundamental kind of issues, right, which take time to resolve. It's not something you can do just like that. So this slowdown perhaps could persist because the general feeling is the top end of the consumer is kind of maxed out. At the lower end, there isn't very much happening, and the middle part, I mean, the upper middle part is also has spent itself out quite aggressively over the last 3-4 years. So go on.
Prashant, yes, by and large, agree with you. First, on the FII part, yes, China was the main trigger, but even before the China factor, FIIs were not really overly enthused with India at the valuations we were in back in August or early September. So they have been complaining about high valuations. We were not seeing fresh money coming to India in a big way, apart from some of these IPOs and blocks and QIPs, which was very tactical. The bulk of the outflow that we've seen from FI so far is really from index funds, from hedge funds, from proprietary trading desks who trade India sitting out of the region. This is somewhat more what I would say tactical, somewhat more momentum type of money. The deep long-only money is yet to move out of India in a big way. If I remember correctly, FIIs own about $850 billion of Indian assets, Indian equities. And so far, we've seen only $12-13 billion or so moving out. So if China really were to take off, you could see a lot more selling. But that's not the base case. That is not what most people expect. There are structural issues in China which will take a long time to resolve. A little bit of stimulus here and there could lead to a rally in the short term, but most folks are still, sort of skeptical. So that's as far as the foreign selling is concerned. It was more our own valuations which were keeping foreigners away. China just turned out to be a trigger to book some profits in India, move on elsewhere. As far as the consumer side is concerned, I think one or two important factors to keep in mind. We've also had very weak government spending in the last 6 months from, let's say, April, May till September, October. And the government is now sort of, realizes how it's been falling behind. And we think in the second half of this financial year, we will start seeing a very sharp uptick, although it may still not catch up to their full year targets. But you will see an uptick. IT services, which is another source of high-end jobs in India, that, again, the worst is over. You till turning a bit more positive as we go into the second half. And also, the rural income, monsoons have been good, so the farm income should pick up. Exports, we had the worst of the Red Sea crisis, freight rates going through the roof. European and US economies doing not so well. Now, those things are all, again, the worst is over. So export should also perhaps not do as badly. So overall, it will pick up, but as you rightly said, it may persist for a bit longer. I don't think it'll last for, we structurally, the economy is doing well and we are recovering post-COVID, so that recovery should continue. The consumption recovery, all we are saying is will take a bit longer. It won't recover until,
Sure.
some of the things start working out.
Okay, all right, Pratik, got that. Thank you very much. That's really helpful perspective. We'll keep it in mind. Once again, wish you season's greetings and a great festive weekend as well. We look forward to connecting again soon.
Thank you.
Thank you. Thanks. All right, let's move on now to our next corporate conversation. And the company and the stock on the radar now is Tata Power. The stock's actually a little flat, reacting to, well, a mixed set of numbers for the second quarter, you can say. Now, the company's revenue was marginally lower. This is because the generation part of the business saw a little bit of softness. The power demand itself was weak because of the monsoon period. However, Tata Power's solar business has done really well. And there were a couple of one-offs on the distribution side as well with the Delhi Discom business, which helped, accelerate the profit level growth. And on the solar side, one of their key facilities, the solar, cell and module manufacturing facility, that's also coming on stream. So we have with us Mr. Praveer Sinha, MD and CEO of Tata Power, to give us some more color on how the next half of the year is looking. Mr. Sinha, thank you for joining in, sir. Happy Diwali, season's greetings to you and your teams back at the company and all at home. So let's start by understanding, power demand itself, and then talk about generation, what's happened there. Now, is there a sense that power demand is kicking back in? I think anyway at Mundra, you had a shutdown from August. That was a planned maintenance shutdown. The Section 11 has been extended now till, I think, December. So let's talk generation first and what you're expecting from that part of the business in the second half of the year.
Good morning, and thank you for having me on the show. Happy Diwali to you and to all your viewers. I think for Tata Power, we have been consistently doing quite good. This is, in fact, the 20th consecutive quarter in which we have shown a growth in profit. And for us, this has been the trend because of very strong foundation that we have set for all our businesses. You mentioned about generation. So our generation is our cash cow, continues to do very well. And all our plants are operating at good capacity. Of course, Mundra, we had an issue in the month of September, and that's why the generation was little less. And that's why it has the impact on the revenue. But the performance per se has been good, and it continues to generate the cash that it is supposed to do. All our plants, I think all our generation plants have consistently done well, including our renewable plants, our solar and wind plants. Of course, the solar was little less compared to the plan that we had, but we definitely have seen very good wind speeds, and that's why our wind generation has gone up. I think what is important is that some of the things that we had said we have implemented, and the results will start coming in. Our 4 gigawatt, 4.3 gigawatt of solar cell and module manufacturing is now operational. The 4.3 gigawatt module is fully operational and has stabilized production. In fact, in the last quarter, we had record production, and that will be the way going forward. The cell plant also got commissioned during the last quarter, end of the last quarter, and it is at present getting stabilized, the first 2 gigawatt.
Right.
The next 2 gigawatt will get commissioned in November. So I think by the end of this third quarter, you will find both the cell and module plant operating at full capacity. And the results, of course, will start coming from the fourth quarter onwards. So we are in good shape in all our areas.
So, sir, exactly on that, I mean, because there's so many different businesses, right? So if you put it together, we're just trying to get a sense of the top line for the company, FY25, as the solar picks up and perhaps Mundra is, going to come back as well. And also a word on the distribution side, right? So top line growth, what can we expect from Tata Power, all the businesses put together this year?
So I think the top line is about 10% growth that we are looking at, but our other financial metrics will be much better than that. And you have seen that our EBITDA has improved because our margins have improved, and we are able to do much better in our distribution business. Odisha Discoms, the billing and collection has improved, and the AT&C losses have reduced over there. Similarly, the impact of the solar cell and module we'll start seeing from Q4 onwards. So that will help us in our both top line as well as in our financial metrics of EBITDA and PAT. We will also see some of the projects that we are implementing, the renewable projects, they will get commissioned within this financial year. So the impact, of course, of that will start coming from the next year. So I think generally we are on track, and whatever we have planned, we will be implementing. And we yesterday also approved the pumped hydro, the 1,000 megawatt at Bhivpuri. So there the work will start in January. So I think what is important is that the fundamentals of the company are very good, very strong foundation. And many of them will start coming, the results will start coming in the subsequent quarters.
Okay, Mr. Sinha, good morning. Prashant here, and season's greetings to you, sir, and your team. I have two questions. As you know, the industry as such catches up with the power demand now and power demand projected over the future. Is there a risk, and you've seen the industry a long time, and this is more of an industry question as well, are we over-investing in power? I think there is some 80 gigawatt worth of thermal capacity which is lined up, which will come up on stream by 2032. Do we run the risk of perhaps over-investing? We'll only find out a few years down the line, but just your sense, sir.
Good morning, Prashant, and happy Diwali to you and your family. I think what is important is that the consumption growth has gone up tremendously because of the availability of power. If you remember a few years back, we had large number of places in the country where the consumption pattern was not there because the availability of power was not there. Thanks to the government program of Saubhagya, now virtually every village is connected and their consumptions have gone up. We've seen that. In fact, in Odisha, we have seen that the consumption has gone up by 25 to 30% because now that the distribution system has been taken care and the last mile connectivity to the houses has been done. So I think what is important is that once the consumption increases, then whatever capacity that we are planning will not only be just adequate, but possibly little less than what will be the demand. Similarly, the industrial growth that we have seen, the offices that have come up, the data centers that we are seeing, which are coming up in the country. So I think there is a huge upsurge in terms of the demand of electricity. And whatever capacity that we are actually building today is getting fully consumed. In fact, we still find that certain hours of the day, the peak power, especially in the evening time from 6 to 11 in the night, there is still a shortage. And that's why some of the peaking power like the pumped hydro and the hydro plants will support them to meet the requirement during these hours. So I think what we are doing is right. Possibly there is a need to enhance the speed at which some of these projects are setting up.
So finally, I was also going through some of the analyst reports. One of them pointed out that while, of course, the prospects are looking very, very good, the only risk is any potential delay. So let's address that in terms of your targets, 15 gigawatts on renewables, and also the capex trajectory. I think you're supposed to put 20,000 crores to work this year. Is that still the plan? Are the timelines intact? Because you're doing a lot more. I mean, you're buying, I think, a hydropower project in Bhutan. Then there is this 5,600 crores going towards pumped storage hydro. So outlook on capex and whether you can meet these timelines, 15 gigawatts renewables by when?
So in the first 6 months, in the first half itself, we've invested 9,900 crores and against the 20,000. In fact, now we have enhanced the budget for investment in this year to 22,000. By another 2,000 we have, because many of the projects which we were planning to do in the next financial year, we are trying to complete it before March. And I think the impact of it in terms of higher EBITDA and PAT will be seen from next year. So we are very much on track. We monitor all these projects. And what is important is for our renewable project, we now have a control on supply chain. We were earlier dependent on importing these cells and modules. Of course, plan got delayed, so some of the projects of the first half will come up in the second half. But now we have full control of 4 gigawatt of cell and module, which typically will be used for our own projects as well as for projects, third-party projects, and the rooftop that we are doing in a very large way. So I think we are very much on track, and whatever we have promised, we will possibly end up doing much better than that.
All right, Mr. Sinha, we'll leave it there, sir. Thank you very much, and look forward to speaking to you again soon. And enjoy the holidays, the Diwali break. Thank you very much for joining us here on CNBC TV18. Markets, by the way, are down about 55 points. There is selling, which of course is emerging, but there is also from the lows a little bit of buying which has come through. So we're about 50 points off the day's low, but there is a bit of a struggle, definitely. Look at market breadth as well. 1560 stocks are higher and about 800 stocks are lower. So that's clean 2:1. And that's the silver lining, really. Broader markets doing much better like yesterday. So let's hope, that counts for something, and it shows up in the frontline indices as well. We'll take a quick commercial break here. We'll be joined by the management of Kaynes Technologies. So that's a leading EMS play, getting into the semiconductor value chain as well. Jairam Sampat of Kaynes on the other side. Okay, welcome back. If you're just joining us, wishing all of you a very happy Diwali from the entire team here at CNBC TV18. We've, of course, been in conversation with various managements on the back of earnings, and let's welcome in the next one. Kaynes Technologies reported numbers for the second quarter. Numbers are largely in line with expectations. Margins have expanded. Revenue growth has been aided by strong UPC growth, while profits have also surged near 90% on a year-on-year basis. We have the management now joining in to take some questions. Jairam Sampat is CFO at the company. Jairam, good to have you with us here. Good morning. Season's greetings to you and your team, your family. Thanks very much for being with us here. I just want to start with the margin beat that you've reported. What were the drivers behind the margin improvement that we've seen, and what can we expect in H2 and the full year FY25?
Yeah, thank you, Prashantji, and a very happy Diwali and a nice New Year to all of you and your viewers. See, fundamentally, margins are driven by two things. Okay, one is at the gross margin level, which is driven by the mix of the business. We are, as you know, diversified portfolio company. So we have 6 different business verticals. So there were more business probably we did in industrial vertical with a slightly better margin. So there was a margin improvement. The second driver of margin is also the kind of leverage you get. So we think that in the second half, we will be benefiting by both of these drivers. So probably we will do almost twice as much as what we did in the first half in terms of revenues. So that will give you good operating leverage. Plus, some of the verticals, which are high yield verticals for us, will also be firing up. As you know, there have been some small delays in the government spending taking off, but we see sure signs of these coming up now. So you can expect in the second half slightly better performance on margins and so on. And so we think that it will be probably a good margin expansion in the second half, leading to about 15% plus kind of EBITDA at the end of the year.
All right. Hi, Jairam. Good morning and good to see you in. This is Nigel on this side. On the revenue front, if you could give us a sense, will it be closer to 3,500 crores? You're saying 3,000 crores is the guidance, but you're not ruling out a beat out there. So what could that number be? Margins, you've told us it should improve in the second half, so we'll maybe take it at more than 15%. And also, I wanted your order book breakup between the segments. You've got the absolute number, but between segments, if you could break it up for us.
Yeah, so at this stage, we would still maintain 3,000 crores plus. And we do see a lot of bullishness in terms of order booking, and some of the customers are coming back with more and more commitments for the future. Maybe by third quarter, we'll know more clearly how much more we can do. But this 3,000 crores plus is certainly very high probability. And of course, we do have better margins also coming up due to the reasons that I said. So in terms of color on the order book, right now, the order book is dominated by industrial and automotive segments. And we have some railway and some aerospace and those segments coming up now. So post, let's say September, in October, November, December, we probably will see some increase in the order booking in those segments too. It has taken maybe due to the election quarter, the first quarter was election quarter, so there was a kind of delay, but I think it will all pick up now. So we think that we'll exit this year with a fairly good order book, not only in terms of numbers, but also in terms of those sectors which are high yielding for us.
Okay, all right. In the longer run, how do you see the smart meter segment shaping up? There's a big potential over there, but what is the revenue outlook as a percentage of the total, industrial contribution? What can it give?
Yeah, so see, right now we are looking at about 15% to 20% of the total market of smart meters in India domestically. Smart meter business has got two parts. One is domestic, and then I think slowly the international or the export portion will also come up. We have a very large European client, and we have kind of got approvals from them. And then maybe as the domestic business stabilizes, then the export business will also start off. So I see next 5 to 10 years time frame. This will be a significant portion. I think at a peak, we will do about 1,000 crores of smart meters on an annual basis, based on whatever capacities we have planned. So I think it will be fair to say that of the total revenues, maybe this year smart meters might be just about 10-15%, and then going forward it probably will remain similar because the other businesses also will grow. And so that's the outlook on the smart meters.
Okay, let's talk semiconductors, Mr. Samvat, because that's what the market gets really excited about, right? So how are the sort of plans and the works coming along for the Gujarat facility? And also now, do you have some more clarity on how the breakup is going to be between OSATs? What perhaps could be the revenue potential? Some more details now on semiconductors.
Quickly. So the land acquisition is completed and we have started the construction there. And hopefully by end of the year, we would have the lines coming in, and maybe we'll establish in the first quarter and we'll do the POC line, which is called proof of concept. And we should get approvals in place before the first half of next year. And then by fourth quarter, we should start doing reasonable revenue. That's 40% of, let's say, what we call the phase one implementation. And we have now better clarity in terms of how we are going to have, who is going to be the anchor customer in the beginning stage, and then how the entire thing is going to shape up. So we think that for a total capex of about 3,300 crores, the revenue potential by, let's say, FY30 should be close to about 4,000 crores of revenue. And the way we have configured and the way we have strategized and planned our capacities is that this should be margin accretive compared to the existing businesses. And so we are trying to be future ready in this business. Yes, right now we have huge amount of support from the government on capital subsidy. But going forward, we think that this business should be able to generate resources by its own to add capacities beyond the 3,300 crores that we are talking about. So yeah, going is good. We have got the team in place and some of them are camped in Gujarat right now. And so maybe by the next quarter, you will know better about how the building is coming up and so on. And yeah, first quarter of next year, we should probably have the POC running and maybe some customer approvals. Though we have promised by fourth quarter FY26 commercial revenues, we are trying hard to advance it by a couple of quarters so that we
your investors will absolutely love that, sir. Like I said, it's the buzzword, the hot area right now, right? So you're saying fourth quarter of FY26 for sure, maybe even earlier than that is when the first revenue starts coming through. You also mentioned that the margin is going to be more accretive. Typically, how much, as you look at the calculations right now, what will be the gap between, say, the blended margin? Right now, you're talking about 15% EBITDA margin. With this business coming through, how will the margin profile improve and change?
Yeah, so see, we have to look at both the things. One is margin, the other is the ROC. So we are more worried about the ROC because these are capital-intensive businesses, right? So they give you 1 to 1.5 times the asset turns. So we are quite acutely aware of the fact that margin cannot be 15%. It has to be something like a 27% kind of number. And we think that may not be by Q4 of 26, but eventually by FY30, we should have a margin which is 25-27% kind of number on EBITDA, so that we do have a fair chance of giving a 20% plus ROC to the investors. So this is how we look at it. And because the EMS business is asset light and it has 6 to 7 times asset turn, so a 15% EBITDA with whatever profile of working capital that we have yields a fairly reasonable ROC. So we are trying to balance out all. See, we are also looking at the sustainability of the business on its own.
Right. So, Jairam, if I can just come in. Yes. Sorry, apologies. CG also was one of the players which got the PLI, right, along with you and Tata's
yes.
for this business. If my memory serves me right, maybe wrong, and apologies if I am. They said that margins would be 16-17% in this business. Are they doing? Is it something very different?
Yeah.
What are they doing?
Yeah. So I mean, this similar story to what EMS play is. So it depends on what exactly you do. The margins will differ. So there are two. Let's say broadly for the purpose of this discussion, we split the entire assembly parts into two. One is the legacy kind of work, which is predominantly what perhaps the other players are doing because they have one anchor customer and they move the legacy business here. That's also good to do if they have large volume and they have some other strategies in mind later. But in our case, 25% of capex only we are aiming towards the legacy production. The other 75% is aimed towards what is known as advanced packaging. And we let's say, there's a bold initiative on our part. What we are straddling this entire advanced packaging, one at the entry level, which is like stacked dies and 2.5D, etc. And one at the other extreme high-end level, which where we'll do prototyping, etc., which is like the co-packaged optics and so on. So what we are trying to do is, while we find our feet in this business through legacy packaging, etc., we quickly transition to be a company which can be trusted to do advanced packaging, and especially for the new products. So that is the strategy right now. So I think we will get there because there is a gap in that particular part of business with a lot of front-end fabs trying to develop as OSAT for advanced packaging. So we think that companies like us and some other people who set in capacities later, if they do it for advanced packaging, I think the margins in advanced packaging are far superior to the legacy packaging. Legacy packaging is the kind of number that you're talking about, and advanced packaging will be twice as much actually.
Okay, this requires a full other conversation, but it's a new line of business and lots of excitement here. Thank you very much, Jairam, for joining us. And once again, wishing you a very happy Diwali from all of us here on at CNBC-TV18. Markets around about 65 odd points, 24,275. I think we have the management of IRB with us.
Yes, and IRB has had a slightly subdued quarter. If you look at the Q2 trends, the company's revenue and EBITDA declined. Profit also saw low single-digit growth. The total collections took a bit of a hit due to perhaps heavy monsoon, slightly lower traffic. But let's find out how the second half is looking like. We have with us Anil Yadav, Director Investor Relations at IRB Infra, joining in. Mr. Yadav, thanks for joining in, and season's greetings to you. Happy Diwali. And that's really the question, right? I mean, what are you now noticing? We're already, well deep into the third quarter. Are the traffic trends, toll collection trends picking up? And was it just pure, seasonality, or was there anything else that led to the subdued performance in the second quarter?
Thank you. Thanks.
Anil,
Yeah, hope I'm audible.
Yes,
Yeah.
yes.
Thank you. Thanks for having me here. Wish you happy Diwali to you and your team members, including your viewers. Now coming to the numbers, I think second quarter is anyway impacted because of the monsoon, and we have seen a severe monsoon in this financial year. And in fact, in spite of these challenges, result is in line with the analyst expectations. Now coming to the Q3 and Q4, anyway for us Q3 and Q4 is more robust quarter, and we will expect better performance in terms of toll collection as the festive season is starting. We have already started witnessing higher volume growth on our road project, and that typically is higher in Q3 and Q4.
But Mr. Yadav, the thing is that, okay, I mean, toll collections, maybe there's seasonality there, but your EPC order book, and that's a concern, right? And this has been discussed quite widely, the fact that NHAI simply is not giving out as many orders this year as it was doing earlier. One argument is that maybe a lot of the, at least from an NHAI perspective, a lot of the network is already built. So what are you expecting in terms of future, order activity? What is the order book growth that you are going to aim for in the second half? So total order book for FY25, if you could share some projections and numbers.
Yeah. So I think as far as long-term opportunity is concerned, we have national highway. The government has planned to double the national highway to 2 lakh kilometer. So far, we have constructed only 1 lakh kilometer. And if we will talk about 1 lakh kilometer to be constructed, there the cost will be roughly 50 trillion rupees, and which needs to be constructed over the period to 6 to 8 years. For long-term visibility, we have a good order visibility as far as road sector is concerned. And considering the finances of the government wants to push for the PPP project. And out of the 50 trillion opportunity which is going to unfold, out of that, we believe that around 20 trillion, 40% of that will be on PPP basis. And we will eye to get at least 10% of the PPP project, which will translate around 2 trillion kind of opportunity for IRB. And we have
that's Anil. So let's put some timelines to this as well. If you could tell us, your total order book as of now is 32,600 crores, right?
Yes.
As you look to capture this 10% potential market, where does your order book go by the end of this year and maybe then FY26?
Yeah, so as I was talking about the long-term opportunity for 6 to 8 years, now I will come down to the near-term opportunity, which will get bidded out recently. So we have a BOT project which are lined up, almost 37 to 38,000 crores of BOT project which are already lined up. And plus there are 4 TOT projects which are also lined up. Probably this will get bidded out in the November and December, and we expect good order inflow. And if you look at the historically also, the most of the award happens as far as NHAI is concerned, second half of the financial year, and that also towards the end of the financial year. So I think considering this thing, we have a visibility for next 6 quarters as far as order book is concerned. We have executable order book for 6 quarters. And considering the pipeline, we expect that we will get good order inflow in the coming months.
All right. Hi, Anil. Good morning, and wishing you, your team, a very, very happy Diwali. Give us one final number before we let you go. You've told us the longer-term projections. What about FY25? The revenue growth, EBITDA, and profitability. On the revenue growth, you can break it up for us. How much will EPC contribute? Please go ahead.
Yeah. Wish you the happy Diwali and your team as well. Now coming to the FY25, as we have guided at the beginning of the year, we expect around 10% kind of growth in terms of the revenue and in terms of the profitability. First half was a little bit impacted, and it will depend upon how the second half will pan out. We are the numbers of the October is quite encouraging. We expect that we should be able to deliver what we have guided at the beginning of the year.
Okay. All right, Anil, we'll leave it there. Thank you very much for joining in and giving us some more projections and some perspective on the business. That's IRB Infra talking about a better second half. We do have to take a break right now, but as we do that, as CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policymakers like Finance Minister Nirmala Sitharaman, RBI Governor Shaktikanta Das, industry leaders like HSBC India's Hitendra Dave, Kotak Mahindra Bank's Uday Kotak, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. So you don't want to miss this. Okay, we've still got a tinge of red on the benchmark indices. Sensex Nifty lower by about 0.25% as of now. And if we look at some of the major movers and shakers, of course, the tall leaders of the day continue to be Cipla and L&T. L&T is now surging 6% higher, and Cipla is retaining a bulk of that 7% gain as well. ONGC Power Grid, actually interesting day for some of these PSUs, BPCL. So after a long time, large PSUs at least, count in SBI, good day for the large state-run companies.
Just one name, Vari Energy, we should put that name up. Deepan was telling us that his Diwali pick for the year is Vari. Disclosure, he said, well, he and his clients are looking at, are sort of in the process of building a position. Stock's up 9.5%. It's at the day's highest point. So, yeah, I mean, that's something. It basically made it to the market at 2,500 and right now at about 2,680 at this stage. So that's the second biggest volume-led gainer across the board. L&T is, of course, as Surabhi said, 6.5 higher. Cipla is up about 7.5. There's Reddington, Polymedicure. Again, a company we spoke with recently. I think it was day before yesterday.
Yes.
10% yesterday, another 5% this morning. UTI AMC, 10% yesterday, another 4-5% this morning as well. So there is a fair bit of action, stock-specific wise. Let's talk about commodities and what's top of mind. Manisha is here with exactly that. Manisha, good morning.
Morning, and thank you for that, Prashant. And what a year it has been when you look at commodities. Almost everything surging up. And it has been a year for precious metals, really, because you did see gold and silver prices gain up so strong. It has been an all-time high for gold and silver prices in this year. We've seen 41% of returns in case of gold, 47% for silver. And platinum clearly has been a bit of a laggard, but positive gains coming in for that one as well. With the kind of geopolitical uncertainty that we are looking at, and of course, the geopolitical tensions, all of that has been supportive. Well, metals clearly has been a mixed bag, really, because we've seen copper, aluminum, zinc do quite well. Double-digit percentage gains coming in for this one. The best gains clearly coming in for zinc with 24% of gains there. And the other metals have been actually negative in this year. This weak Chinese demand, also higher inventories, higher supplies continue to take the prices down for this one. So lead, nickel, steel, iron ore, as you can see, double-digit % decline onto this one. I want to take you through energy now, where we've seen the crude oil prices continue to decline, down 14% in last 1 year. And that pretty much has been the case with the rest of the energy basket as well. Natural gas, heating oil, double-digit, more than 20% of a decline in the past 1 year. That is because Europe has now enough inventories, and markets perhaps could see some gain ahead of the winter season. But at this point in time, the supplies are higher, and the US is producing nearly record highs. Come to the soft commodities now, and this also has been a mixed bag. The gainers gained a lot, and the losers also fell down by double-digit % decline. So within the edible oil space itself, you had soybean prices falling by 24%, and the gainer clearly has been palm oil. Remember, Indonesia has come out with B40. That means blending of palm into ethanol is going to be much higher, and that clearly has been taking that commodity higher. Rubber, again, the automotive demand has been strong, so we've seen 35% of gains onto that one as well. Within softs itself, you had coffee, cocoa gaining quite strongly, nearly 93% of gains coming in for that one as well. And sugar prices have seen a decline in this year. Well, this is what we've seen in last one Diwali come in for commodities. But getting into the new year is going to be quite interesting, because you will see the presidential elections, the way geopolitics panned out, weather, and of course the Indian markets as well going forward, the policies that will tell you on where the commodities really go.
The commodity queen, come on over, join in. And viewers, you can now see right behind us, this is Team CNBC TV18 in full force and full strength in all of their Diwali splendors. Guys, are you ready? You know what to do. 1, 2, 3. Happy Diwali!
We have to keep that.
afternoon. Welcome to our Samvat 2081 Market Masters special. It has been a sobering October as we ride into, midway into Samvat 2081. The Nifty is down 7.5% year to date and, from its all-time highs. And it is still trading at nearly 23 times FY25 earnings. That is, in 6 months, the year ends. The Q2 earnings has also been marked by slowdown at the bottom of the pyramid. MFI and FMCG, microfinance and FMCG companies are showing pain at the bottom. But cutting-edge companies, EMS and e-commerce and private banks have all been a picture of strength. So how will Samvat 2081 pan out, or the rest of fiscal FY25? Let's invite our market master, Nilkant Mishra of Axis Bank. Nilkant, thank you very much. Happy Diwali to you and everyone at Axis and your family. It's very important to have you because I think macros and markets are in a spot of bother. First, the macros. The GST collections was the first heart attack, at least for me. 6.5% when nominal GDP should be 10-11%. Are you worrying that the economy is slowing, or is it just seasonal?
I think the economy has slowed, and this is something we've been flagging for a while. For a while, people thought it was just the intense heat or the elections, and then it was heavy rains. But no, we have to face reality. Most high-frequency indicators have slowed very sharply. And so everything from cement volumes to power volumes to car sales to CV sales to, you name it. I can't think of any high-frequency indicator which has actually improved in the last 6 months. So
I'll show three pieces to counter, to play the strong advocate. Vahan data is now available for the first half of the festive season. And there the two-wheelers are up 12%, a damn good number. Not PVs, passenger vehicles are still flat, but two-wheelers at 12%. And the other data, the core sector data for September that came out, cement alone has done well, though it has had a very bleak
1.7% or something. So I don't think, remember that.
Not good enough.
Cement was growing at 11-12%. This is an investment-driven recovery. If the GDP has to grow at 7, cement has to grow at 9-10. So it is, thankfully it is not zero, which is what for the quarter our analyst expects, that is estimating that the industry as a whole pretty much didn't grow. Or even if it is 2 or 3%, I don't think that suggests a strong economy. The Vahan registration, I think there are several distortions that can happen if you only look at 15-20 days of data. The bigger picture is that the car market is a much bigger market than the two-wheeler market. From an overall economic perspective, I think even the credit impulse is down, right? So credit growth had slowed below 13%. So I think on a whole range of parameters, the economy has slowed. The question for all of us is this a temporary slowdown? If it is a temporary slowdown, then we should be buying into the weakness. If it is a much longer term slowdown, then it is better to book profits and stay out for a while. I think it is the former. It's of what I call unintended level of fiscal and monetary tightening that the economy has slowed down. We can see that corrective action is underway. And my expectation is by maybe Jan, maybe Feb, the high-frequency indicators should start improving.
Okay, so you're saying that the lack of expenditure in the first 2 quarters by the government meant less fiscal impulse, and the Reserve Bank's liquidity, tightening, not so much rate, but liquidity, yes, which is considerably loosened in the second quarter. Those two will create growth in the second half?
Yes, and I want to spend maybe an additional half a minute on the liquidity side. So it wasn't just the RBI keeping liquidity tight. It was also, I think, the discomfort it had on the high loan deposit ratios, and which were communicated to the banks in March, April, which meant that we pretty much triggered a downward spiral. As you know, deposits are created when loans are given. So if the banks start cutting loans or slowing down loan growth, it slows down deposit growth, and then the whole thing sort of goes into a downward spiral. So if you look at incremental credit impulse, that is FYTD, what we have done, the growth has been far lower than what we saw in FY22 and 23, and in 24. So therefore, I think that has had a very significant impact on the economy as well.
Oh, yes, and perhaps it was called for, at least in areas like microfinance and unsecured credit.
I'm not so sure that, so see, we have to be very clear on this, that while there were possibly excesses emerging in small buckets, see, there are broad brush tools. So there is, CRR, SLR, overall credit growth, LDR, LCR. But then there are these narrow buckets. So if unsecured personal loans are, say, 7-8% of banking loans, or the MFIs are all put together, maybe 4 or 5% of aggregate loans. If those have to be targeted, and it is perhaps required that there be a slowdown there, then the tools have to be different from an aggregate credit slowdown.
Okay. Now, to be fair, they did do macroprudential rules, like, for instance, they increased the risk weight on unsecured debt. They did not raise rates nor squeeze liquidity out. But Neelkant, therefore, what is the take?
Out. No.
Yes.
See, let's be very clear on...
Liquidity was squeezed out in August, Neelkant, and that was because last August food inflation went to 7.7.
No, not August. See, the fact that food inflation is very high, and that makes the MPC's job very hard, given that there is now evidence coming through the economy is slowing, but the headline inflation that they need to be targeting is still elevated, is, I think, a very complex problem. I don't think we should underestimate the challenge. But the liquidity tightness and the fact that the central bank created a share, or so the M3 share, as you know, broad money, there are only two entities that can create, commercial banks and Reserve Bank.
Yeah.
The Reserve Bank share of incremental money injection in the last 2 years was 14%. It tends to be about 18 to 20%. Now, what we have seen since July, because RBI has started to ease on that front, I think clearly seeing that problems are emerging. And now, the banks then take time to understand that this is the signal. And with the stance changing to neutral in October, I think incrementally things are easing further. And my expectation is in the next couple of months, even the banks that are still, I think it's a lagged response to the liquidity tightness a year back. There's still a rush for bulk deposits. The rates are too high. Some banks are still holding liquidity. That may not be necessary. So as the banking system understands that the RBI's liquidity stance has changed and has changed for good, I think that's when the credit impulse starts to improve.
Okay. So how do you play this in the market? Do you buy the dip? And when you buy the dip, which dips? Which sectors?
So because the flows were happening. So remember, because now that we are moving to the market, so let's put things in context. We've seen FII selling continue through all of October, right? So we've seen about maybe $11 billion maybe go out. And this is a very, very strong pace of exit, meaning that just 7-8 years back, $15-20 billion of inflow in a year used to be a very good inflow. Now we are seeing $11 billion go out in a month. And while domestic flows, I think, have been largely steady, there may have been some HNI numbers, which we'll see in a couple of days, but on the EPFO, SIP, insurance, all of those flows are give or take $4 or $5 billion a month, which is a lot, but it's very small compared to $11 billion of outflow. So if you see that pace of outflow, the market will take a breather. Now, which sectors to prefer? From, I would say, April, May, June onwards, there was a move to defensives. So IT, staples, pharma had outperformed significantly, despite the fact that for some of these sectors, IT and pharma, the earnings were still getting cut. And this was, I think, the fund managers responding to the high frequency indicators slowing down, but having to cope with steady inflows. As we start to see a cyclical recovery, so you talked about private banks doing a bit better, because clearly for the banking system as a whole, the challenge over the last 2 years has been that on the quantity side, I mean, the raw material that the banks work with, that had started to become a problem.
Shrink.
And therefore, as we start to see that raw material improving and at the margin, the deposit pressures, the deposit rates should start to ease because the quantitative side we are starting to ease. I don't expect rate cuts to happen, by the way. I mean, I don't think there'll be room for rate cuts till February or April. April may be the earliest that we should expect. But on the quantitative side, I think things will start to ease, and that should definitely help the banks. I expect, and we saw some order books from the large industrial companies yesterday, at least surprise on the upside. So the capex cycle, at least so far, seems to be intact. And as the cyclical recovery happens, those would be the sectors that I think will benefit more.
Okay, not consumer discretionaries, EMS companies. EMS numbers are good. I know it's a small sector, but it's doing well.
Yeah, it's doing well. And I expect, I mean, I'm part of the India Semiconductor Mission, and I'm actually seeing it from close, very proud of what the country has achieved and the momentum that we are seeing, not just on the...
So your bets are on capex and private banks? Okay. Okay, that's two very good sectors to work with, two large sectors, give you some choice. Neelkanth, we have to cut short this discussion because we've run out of time. But I'm going to take a rain check from you and invite you for a wholly economy discussion. I'm not done with discussing this jarring goal that the MPC has in terms of food inflation as well, and probably growth requiring a bit of help. On that note, we have to wrap up on this special Samvat Market Masters Chartbusters time after a break. बात करो या Hello and welcome to our Samvat 2081 Market Masters special. It has been a sobering October. As we ride into Samvat 2081, the Nifty is down 7.5% from its all-time highs 1 month ago, but it is still trading at nearly 23 times FY25 earnings. The Q2 earnings has also been marked by slowdown at the bottom of the pyramid. MFI, FMCG companies are showing that pain, but EMS companies, private banks have all been a picture